Good afternoon, everyone, or good morning from Washington, D.C. This is Ken Carrar, the CEO and President of the Council of Insurance Agents and Brokers, and we're going to hold for 1 minute while the participants or attendees are signing in to the webinar. So we'll be right back. So good afternoon or good morning, everyone from Washington, D.C. I'm Ken Carrar. I'm President and CEO of the Council of Insurance Agents and Brokers, and we'd like to welcome you to our call today on the Small Business Administration's Paycheck Protection Loan Program. The Council is located in Washington, and we represent 200 of the top commercial insurance and employee benefits brokers and consultants. Your brokers are the top market leaders and members of the Council. They've made an investment in the Council because they understand the value and the importance of having a voice on Capitol Hill and having strong legal counsel that can leverage the collective power of other market leaders so they can advise and provide you with the timely and relevant intelligence and information you need to manage your business. These are unprecedented times, and we are all grappling with the uncertainties that lie ahead, and your broker continues to be among your best advocates through these difficult times. Today, you've been invited as a client of our broker member as we unpack the complexity and specifics of the Small Business Administration Paycheck Protection Loan Program under the CARES Act. Navigating the federal legislative and regulatory landscape is one of the cornerstones of what the Council offers its members. We're joined today by our legal team at Steptoe & Johnson, who've been working around the clock to dissect and clarify the specifics of this program. Let me take a minute and explain the Q&A process. There is, at the bottom of your screen, a Q&A box. The Q&A box is intended to provide you an opportunity to ask questions of the presenters, but please wait until the presentation is completed before you post a question. We tend to find out that a lot of the questions are answered in the presentation, sometimes forward or backwards, and it's just easier if we do that. And we'll try to get to as many of those questions as we can or lump them into categories. Do not use the chat box. The chat box is intended for technical issues, whether if you can't hear something, but we are not going to monitor the chat box today for Q&A. That's just, it's impossible to do both. So with that, I'd like to take a minute and turn the program over to Scott Cinder and Kate Jensen from Steptoe & Johnson, who will give you an overview of the Small Business Administration Paycheck Protection Program. Thanks. Scott?
Thank you, Ken. I like these 11:30 start times because I can say good morning to all, since it's morning for all of us still. Why don't we flip to the next slide. So we're going to divide this presentation into 3 parts. Most of it is going to be about the Paycheck Protection Loan Program. We're going to kind of walk you through the details as we now know them. Then we're going to do a very brief overview of some tax alternatives that you now have as a result of the CARES Act, but which you abandon if you, for one, if you participate in the program, and for the other, if you not only participate, but you also receive the forgiveness. So that you understand the trade-off. And then we're going to go through the larger company loan programs. Yesterday, the Fed rolled out its initial term sheet with some of the initial parameters for the middle market, or what is it, the Main Street loan program. And so we want to update you on those to the extent we know them today. So what you have on this first slide, first substantive slide, is sort of a tick list of the big benefits of the participating in the program. The loans are 100% federally guaranteed, which means that the banks do not really have to underwrite them. The bank's sole obligation under the program is to make sure that you have submitted what you're required to submit in terms of your attestations on the application. We'll go through those in more detail later, as well as payroll information that you're required to submit. Beyond that, they have no obligation to ensure that anything that you've said is true or correct. That obligation is on the applicant, and so they have to answer the bell if they've made any failures there. There's a $10 million cap on the maximum amount of loan that you can receive under the program. The biggest, I think, positive feature of the program is loan forgiveness. It's primarily requires you to maintain or restore your pre-crisis payroll. There's some other features to it that we will step through in detail. If you qualify for loan forgiveness, it's exactly what it sounds like. You don't have to pay anything back. It becomes more of a grant than a loan, and the money is non-taxable. And so it really is kind of terrific, clean money if you can qualify for it. If you don't qualify for forgiveness in whole or in part, the balance of the loan has a 2-year maturity. You're going to pay 1% interest rate on that, but you have to make no payments for the first 6 months at all, although interest will accrue during that deferral period. And kind of basically ending where we started at some level, there's no recourse against the borrowers on any level. So the only recourse is against the business itself, unless the loans are used for an impermissible purpose. And we also will discuss in some details what is permissible and what is not. Zach, you want to go to the next slide, please? So who's eligible? So small business concerns are defined in existing SBA laws and rules. We've gone back and forth on this, but it's clear now that you can use either or. Employee counts under the SBA rules are tied to the NICS industry codes, and they vary by code. So many small business concerns, which are businesses, for-profit businesses, many small business concerns have caps under the normal programs that offered by the SBA have far less than 500 employees, but some have more, particularly in the manufacturing sectors. They can be as high as 1,700 employees or more. So if you qualify under the current rules, including these net worth of the business rules and average net income rules, under any of them, you would be eligible for the new program. But the new program also expands to include other eligible recipients. So they would be other for-profit business concerns, 501c3 nonprofits, including churches, and 501c19 veterans organizations, and tribal businesses with not more than the greater of either 500 employees or the SBA small size standard for your industry segment. So they've really tried to expand this out. And you still may qualify if you have more than 500 employees as discussed, but every business and every entity that falls under these other categories up to 500 would qualify. Can we go ahead and change the slide? This was later guidance. This is not included in the initial statute, but it ties back to the loan programs that are normally available through the SBA. So they've now clarified that this is the list of entities that are not eligible, even if they might otherwise qualify. So it include household employers, lending businesses, passive businesses owned by developers or landlords. This is particularly problematic for some in the real estate investment segment. Life insurance companies, businesses located in foreign countries, private memberships, clubs, and businesses. Businesses deriving more than 1/3 of their gross annual revenue from legal gambling activities, and businesses primarily engaged in political or lobbying activities. I just want to pause shortly on that. We have run that to ground. We do not believe that that bars businesses that engage in some lobbying activities. It's only if your primary business is political or lobbying activities that you're ineligible for the program. Why don't we go ahead and switch the slide? Kate, why don't you take us through how you determine your size?
Sure. So this is where a lot of the focus has been during these initial eligibility discussions, and now that the application process is underway for everyone. So as of today, Loans are technically available for any eligible entity. That includes independent contractors and self-employed individuals at this point. So here at the top are the general rules, and these have been around for a long time. This is how the SBA normally operates for determining eligibility for their loan programs. So it's a belly button count. Full-time, part-time, and other basis employees all count equally in your employee count. You count those employees of the applicant and of any U.S. and foreign affiliates. So this has been the key sort of factor for a lot of folks determining whether they can satisfy those employee thresholds. But that is the general rule. The SBA came out with specific guidance on how the affiliation rules would apply for purposes of this program. They're going to look at 4 tests to determine whether an affiliation exists. You can see them listed there. So over 50% ownership, common management, identity of interest between close relatives, and then any stock options, agreements to merge, those are going to be given present effect. So these are the 4 buckets under which they're going to evaluate the affiliations. And then the other thing that they recently clarified is that they're going to do this employee count. So on the application, it just says jobs, and there's a box that you're supposed to fill in, and there's no further instruction. The FAQs now say that that employee count should be based on an average per pay period for the last 12 months. Or you can use the same period that you use to calculate your average payroll costs, and we're going to go over that here in a little bit. So that is not a point in time snapshot number anymore. They are going to take an averaging approach there. Scott, do you want to do the special accounting rules, or?
Why don't you go through them, and I'll add at the end.
Okay. So for some lucky industries out there, you get relief from those affiliation rules. So what that means is the applicant, Joe's Restaurant down on Main Street, walks into the bank to apply for a loan. The bank will only look at the employee count of Joe's Restaurant, not all of Joe's Restaurant's affiliates. So this is significant relief for these businesses listed here. So if you have an NAICS industry code starting with 72, this is generally hotels, restaurants, and bars. You get to count your employees per location. So this is really designed to get those hotels sort of under the tent here. And and the affiliation rules do not apply to you. So you get a waiver for those businesses with the 72 code. You get a waiver of the affiliation rules for businesses operating as a franchise under a current SBA franchise identifier code. That list is available on the SBA's website. There also is an application to apply to get on that list if you are not already. It's unclear to us how quickly they process those applications, but that is an option. And then the last 2 categories here for which those affiliation rules have been waived are businesses receiving financial assistance from Small Business Investment Act licensees and faith-based organizations, so long as the affiliation is based on the practice of religion. So this is the universe of counting as we know it.
I just want to add on the 72 NAICS code piece has obviously gotten the most attention from these departures from the affiliation rules. So even though you qualify if you don't have more than 500 people per location, you still have to apply as a business concern, so as some sort of organized entity. We tend to focus on trying to do that at the level that's most efficient for the holding company in terms of delivering a single loan that will cover the most people. But you have opportunities here to, if you're bigger than the $10 million cap, to go through 2 different subsidiaries to sort of break out kind of your eligibility into the 2 pieces and keep each within the cap and qualify for larger loans overall. Why don't we go ahead and go to the next slide. So the application process. They did update. They issued initial application form, and then literally an hour before applications went live last Friday at midnight, they issued an updated form. which was a little different, caused all sorts of confusion. The form is 2 pages. It's actually relatively simple to fill out. The affiliations piece, I think, is the hardest, just in terms of the work to be done. But you have to submit basic business identification information like address, name, EIN, a list of all owners of the applicant with 20% or greater ownership stake. That includes corporate owners. A list of other any businesses under common ownership or management with the company, and you submit that by attaching another page that lists them. Details on any of the emergency loans that you may have received between January 1st and April 3rd, which you can roll in to the amount of the loan. We'll talk about that in a minute. Information about the individual applicants and any 20%, more than 20% owners' criminal history, and good faith certifications by a business representative, but only one, this was one of the clarifications, needs to make that certification on behalf of both the applicant and the people who own more than 20% of the business. You also have to submit payroll documentation, because that's going to be the magic numbers that establish the loan amount for which you are qualified. One thing to note is that banks, even though they're not required to take more than this, what we've outlined, many of them have imposed additional requirements for whatever reason. Many banks also are limiting their applicants to current business customers. I think they're doing this both to control volume, but also because it eases their compliance with the Know Your Customer rules, since those entities have already been through that. Why don't we go ahead and go to the next slide?
So this is just a little bit more on the good faith certifications that Scott mentioned. So this piece is really meant to take the place of the bank's normal due diligence and underwriting obligations. So the idea and everything that Treasury and the SBA are putting out is designed to give the lenders, the private banks, the cover that they feel like they need. So now Treasury has said the banks will be held harmless if they rely on the borrower's application and certifications. So the things here, these are the items that you're going to have to make the good faith certification on. One of them, the key one, threshold one, is that you certified your own eligibility. So they're relying on the borrowers to do those affiliation analyses that we mentioned at the top, to do your proper employee average count, to include all the employees that you're supposed to in that count. So it's important that when people apply, they understand what should and should not be going into these numbers that you're submitting to the banks. You do have to certify that you need the funding to support ongoing operations during this health emergency. So we think that means that if your business is booming for whatever reason, you know, this is a harder certification to make, but for most folks, we're just encouraging people to keep some documentation showing, you know, whether it's a decline in revenue or, you know, the state orders that are closing certain businesses, so on and so forth, just so in the future you have some sort of reasonable basis for making all of these certifications. And then these are all pretty straightforward. It says that you're going to provide the documentation that your lender needs to establish your forgiveness amount later. You acknowledge that your forgiveness amount is going to be for documented permitted expenses. And you may not apply for or receive another one of these loans during this year. And everything that you submit, you are certifying as true and accurate, and there is potential liability, civil and criminal, if you make any misrepresentations on these applications. So we, in terms of only taking out one loan this year, Scott has mentioned this on previous presentations, but it looks like this program will be refunded at least one more time, if not multiple times after that. So you could see a possibility where folks who take out these loans now, they could be authorized to get a larger loan down the road, but you will not be able to do a separate application for one of these loans this year. I think that's all I have on that slide, Scott. Anything you want to add on this piece?
I think you covered it.
All right. Next slide, Zach.
Maximum loan amount. So as noted at the beginning, the maximum loan amount for affiliated entities, unless you qualify for the exception, is $10 million overall. But the way you calculate what you're eligible for is you take 250% of your average monthly payroll costs. This has been a moving target, but in recent guidance, the SBA clarified that that can either be for the last 12 months or for 2019, but it's an average monthly all-in payroll costs. And Kate's going to walk you through how you calculate that, what's included, what's not. But in addition to that, you can add any amounts that are outstanding from emergency distress loans that you've received this year. You're essentially refinancing that component, less any advances that you're going to take if you also apply for an emergency loan right now and you get the advance. Why don't we go to the next slide, and Kate can unpack the payroll piece as well as talk about what you can use the proceeds for once you have them.
Right. So this payroll cost definition is really fundamental to a couple different elements in the program. So as Scott just said, this is what you will base your loan amount on, just that payroll cost bucket. Treasury SBA guidance says that you must spend at least 75% of your loan proceeds on this bucket, payroll costs. And there are going to be serious restrictions we'll walk through in a moment about forgiveness amounts, and they're going to drive you again toward this payroll cost category. So this same definition applies for all of those purposes within the program. And that's why it's really important that everybody have a really good grasp on what goes into this and what may not go into this. So big change in recent days from how we initially understood the program to operate. You only count employee compensation up to $100,000 annualized. So businesses may no longer count independent contractors or sole proprietors in that calculation, because those folks are eligible to go apply for their own loans and get their compensation based loan for themselves. So we think this is an effort to avoid kind of double dipping issues, and also this very clearly separates out the law firms, the accounting firms, and folks like that who operate as independent contractors but aren't really employees of the businesses we serve. So talking about what can go in this number, it's that employee compensation up to $100,000 a year, paid leave, severance payments, payment for group health benefits, including your insurance premiums, retirement benefits, so that's any employer contributions to a pension plan, 401k, and the only taxes paid by the employer that we think can be included in this calculation is state and local payroll taxes. So moving down to what you may not count, we think any taxes paid by the employer that are not state and local payroll taxes are out. You got to exclude that excess employee compensation above $100,000. You may not include compensation for any non-US residing employees. And you may not count wages that are paid under those obligations from the Families First Act, because those programs are designed so you get a credit, a dollar for dollar tax credit for those wage expenses. So again, this is avoiding a double dipping issue there. So 75% of your loan has to go to that bucket. The rest of the things that you see on the screen are eligible permitted expenses for your loan dollars. So interest payments on your mortgage, any insurance premiums paid by the business, group healthcare benefits. This is a funny one. They listed in both places, both under payroll costs and outside of it. And then you can see a couple of other examples of things that you would be able to use these loan dollars on. And now Scott's going to walk you through. This is your universe of what you may spend the dollars on. Scott's going to walk you through the universe of what amounts will be forgiven.
Before we move, let me say one thing. It's unclear what the penalty is if you don't use the loan proceeds on these permitted expenses. And that's become more of a difficult question, I think, with this 75% requirement that you spend on payroll costs. And now, as Kate has pointed out, that's not necessarily tied to the immediate aftermath, the immediate 8 weeks following your receipt of the loan. So that may be part of the answer. But we don't know what the penalties are going to be if you deviate from these permitted uses. All right, now let's go to the next slide. So I get to tell you the good news, and then Kate gets to tell you the bad news. So maximum loan forgiveness amount. So you can basically have your entire loan forgiven, plus any accrued interest, as long as you spend the money on 4 buckets of things: payroll costs, interest on mortgage obligations, rent obligations under leases, and utility payments, provided that those latter 3 buckets were all in place in terms of obligations prior to February 15th. This is what's in the statute. Then they added this 75% requirement by doing an inverse here to say that not more than 25% of the loan forgiveness amount may be attributable to non-payroll costs. So theoretically, you can qualify for partial forgiveness, but not more than 25% of the overall amount that you receive can be attributable to non-payroll. Any dollars that are going to be eligible for forgiveness must be spent within the 8 weeks after the loan is originated, even for these forgiveness eligible expenses. Anything that's not spent in the first 8 weeks, it does not qualify for the forgiveness. Why don't we look at reductions, which I think is where kind of the rubber meets the road, if you will. And Kate, why don't you walk us through that?
Yeah, so Zach, on the next slide, we'll walk through what types of things are going to decrease that maximum forgiveness amount that Scott just walked through. So you will see reductions in your forgiveness amount. One, like Scott just said, for anything that you spend out of that 8-week period, it's automatically going to be carried forward as a loan. And then in addition, you are going to see a proportionate reduction or reductions in average full-time equivalent employees between your 8-week forgiveness period and a couple of different look-back period options. You can see them there. You get to choose which comparison period you want to use. But generally what they're trying to get at here is whether you true up your employee count during the first 8 weeks of having your loan compared to pre-crisis levels. You will get a straight reduction for salary or wage reductions over 25% for anyone making less than $100,000 a year. So we think you can cut the salaries of folks making more than that all you want without being penalized here. But if you make significant salary reductions for any of your lower paid folks, you're going to take a hit on your forgiveness amount. And then, as Scott said earlier, one of the options you have here is to refinance your economic injury disaster loan that was taken out in the last couple months into one of these paycheck protection loans. When you do that, you get to add your disaster loan amount to your payroll loan amount, but they're going to take off any advances that you took on that disaster loan straight off the top of your forgiveness amount. So those are the things that will reduce your forgiveness amount. But wait, there's still another chance to bring that number back up to your maximum allowable forgiveness. And that is if you basically correct any downward movement in your full-time equivalent employee numbers or in your salary by June 30th. So they're giving you a little bit of extra time there to make up for those numbers that may drop during this crisis period. So the way that we read the statute is if you, by June 30th, get those employee numbers back up to your February 15th level, and you get your salary back up to your February 15th level, then the reductions, the penalties in that first category that you see there will not apply, and your maximum forgiveness amount will be restored. One of the questions that we're getting a lot, and this is a fair question given the timing of everything that's going on with the emergency declaration, stay-at-home orders, business closure orders, is, okay, what if I take out my loan right now and I do everything I'm supposed to do, I bring everybody back, pay them full freight for 8 weeks, And then week 9 rolls around and my business is still ordered to be closed and I don't have any customers. And what if I have to turn around and lay people off again? The way that the statute is written, the CARES Act, we think that there is no ongoing obligation after that week 8 to maintain your payroll to receive these forgiveness amounts. Similarly, if you take advantage of sort of the truing up opportunity by June 30th, you would just hold off on submitting your forgiveness application until that point in time. And again, we don't think that starting July 1st, you have an ongoing obligation to maintain your payroll to receive these forgiveness amounts. Now, huge caveat here, we are expecting regulations specifically on these provisions, and there may be some things, some good faith, maybe it's a good faith promise to try to maintain your payroll if you can, or, we don't know, but SBA may very well try to put some of these things in place down the road. Anything on
that? It's interesting. Under the statute, the SBA guidance on forgiveness is due on April 26th. So you'll notice that's the last date of the reduction period. So by the time you get there, you'll have made your decisions, but we might not necessarily know what their guidance is going to look like. And as we've seen, unfortunately, their guidance can sometimes deviate from what we think the statutory requirements are. The other is, I didn't highlight this at the top, but it was on the slide. The application date, the first date that the banks were allowed to take applications for entities was last Friday. But today, they're allowed to start taking entities from individuals who receive 1099s and anyone who's self-employed. Right now, we think that they are considering anybody who is a K-1 recipient, so an owner of a partnership or an LLC, as being self-employed. And I thought for sure we'd have guidance by today on that piece of the program, but we have seen nothing yet. So we are monitoring that very closely, and we'll provide updates as soon as we have on both of those. Why don't we go to the next slide?
Okay, I can walk through this one real quick. So there is going to be a separate application process to get your loan forgiven. At the conclusion of your 8-week forgiveness period, or after June 30th, when you've made your rehiring decisions, whenever you choose to submit your application, you will need to produce documentation showing how you spent the money, when you spent the money. You're gonna have to be able to substantiate your employee count. And again, there's going to be some certification required by a business representative that the information is true and correct. For loan balances remaining after that forgiveness amount determination is made, the idea under the CARES Act is that the same loan terms would continue to apply to any carried forward amounts, so any amounts that are not forgiven. So that would mean the federal guarantee, the 1% fixed interest rate, and the 2-year maturity period. Again, we keep going back to something, a big question mark here is if you don't follow the rules of the program. So say you end up spending 50% of your loan dollars on payroll costs instead of the 75%, will SBA build in some penalties at this point where you lose some of those positive or favorable loan terms? Again, we just don't know, but we're really encouraging folks, because that is sort of a big open question out there. To the extent you take out one of these loans here in the very near term, just be careful. Make sure you're keeping your documentation. Make sure you're doing your very best to satisfy the program rules, and that's going to minimize any sort of risk to you down the road when we see this second round of regulations.
The only thing I would add is, there's been lots of discussion of different, creative structuring on how to use the money, and does it technically satisfy the statute, even though it may not be consistent fully with the intent of the statute. And it's this caveat we keep mentioning. We don't know what the final rules are going to be, particularly if you don't use the money for one of the usability purposes. And so we can't advise anybody on those sorts of things because we don't know what the rules really are going to be. Why don't we go to the tax provisions? So there are two tax benefits that are included in the CARES Act. This first one, anyone who receives a paycheck protection loan is ineligible to claim the credit. The credit provides eligible employers with a refundable credit against payroll tax, which for most of you will be the FICA taxes, equal to the first 50% or to 50% of the first $10,000 in wages per employee. That includes health plan benefits. This is calculated on a quarterly basis. So we just finished the first quarter. You would, if you're eligible, you would calculate the amount that you paid. So if it were $8,000, you'd take 50% of that, and then you could take the next 50% in the ensuing quarter. But it's for any quarter in which you've had at least a partial suspension of operations due to government orders, or you have a year-over-year reduction in gross receipts of at least 50%. So they wrote this before the pretty much nationwide lockdown orders. So it's unclear if everyone now qualifies for this or not. I'm sure there's going to be some guidance coming out on that, but it's something to be cognizant of. If you have more than 100 full-time employees, only those employees who you are paying but who are not providing services are eligible for the credit. So there's that. Now, if you apply to the program and you receive forgiveness, you're also ineligible for the postponement of the due date for employer payroll taxes. So they included a provision in the CARES Act that allows anyone who pays payroll taxes in the United States without claiming any distress or anything like that to postpone their payment of their payroll taxes that are due this year and the equivalent for self-employment taxes to half next year, by the end of next year, and half by the end of 2022. So that's a benefit that you would forego if you receive forgiveness under the program. You obviously, each business will have to compare the benefits of the loans versus the tax credits deferrals when you think about it from a holistic perspective of the constraints on the use of the loans, et cetera, to decide which you'd prefer to have. But you are making sort of a choice when you go down the PPL path. Zach, can we go to the next slide, please?
All right, so here's sort of a timeline. 3 of the 4 dates already are upon us. The big thing that I'll point out here is that because the FAQ guidance and the rules that are being put out by SBA are coming out on a rolling basis, it's a moving target. People are trying to get these loan applications together right now. SBA has made clear that you may rely on the rules and guidance in place when you submit your application. And if SBA were to issue additional guidance, which I'm sure they will this afternoon or 11 p.m. tonight, that seems to be their preferred posting time, then you don't have to take any action to modify the application that you've submitted. You may though, so if they came out with something that was more favorable or clarified something that maybe you had addressed more conservatively in your loan application, as long as the application hasn't been processed yet, you may make amendments based on new information. And then the only other thing I will reiterate again, because we're going to get probably a lot of questions on the forgiveness stuff, we are expecting another round of rulemaking focused specifically on the forgiveness pieces. We don't know what that looks like yet. And like Scott said, they have not been afraid so far to deviate from the letter of the CARES Act in pretty material respects. So hard for us to even hazard a guess what some of this stuff is gonna look like. But we will certainly be updating our materials with anything new, kind of in a real-time basis as this stuff comes out. Anything else on that, Scott?
Nope, I got nothing. Why don't we move to the lending programs, the bigger business lending programs? Zach, would you mind moving the slide? Thank you. So yesterday, the Fed announced the Main Street lending facility that it is setting up. This is kind of authorized under the CARES Act, but it really had minimal requirements attached to it. It was all left for the Fed. And they've done some interesting things in an effort to make this a little bit broader program than it otherwise might have been. This is going to be similar to the SBA Paycheck Protection Loan Program in that you will apply to your banks to receive this funding. We kind of have some details, but not the rest of the details. So this is not a live program yet, but we now know more than we did on Wednesday. So first, in terms of eligibility, it's anybody who has fewer than 10,000 employees or your annual revenue is $2.5 billion or less. We do expect some further guidance on accounting rules, particularly with respect to how you think of foreign subsidiaries and affiliates. But it also should cover 1099 employees, part-time employees, and the like. The basic loan term is it's available for new loans or to expand existing loans. The loans will have a 4-year maturity. There's no penalty for prepayment. It's an adjustable rate of SOFR plus 250 to 400 basis points. So SOFR, for those of you who are not familiar with it, is the LIBOR replacement that's being bandied about because LIBOR will go away at the end of 2022, I believe. To size this for you, today, the SOFR rate is 0.1%. Last year, at this time, it was 2.1%. Actually, I think today it's 0.01%. But last year it was 2.1 in a more normal economic cycle. So you're looking at rates between 4.5 and 6 points. All payments on these loans will be deferred for 1 year. You are going to be permitted to have both an SBA Paycheck Protection Loan and a Main Street loan. We expect to see details on uses that you'll be able to put the Main Street loan to, especially if you have a PPL loan already. You may not use the money to pay off existing credit. And you may not participate in the primary market corporate credit facility, which I think is really primarily geared at even larger businesses. In terms of loan amounts, the minimum loan size will be $1 million. The maximum loan size will be either $25 million or the amount that, when added to your existing outstanding and committed undrawn debt, does not exceed 4 times your 2019 EBITDA. The maximum loan size for expanded loans will be the lesser of $150 million or 30% of your outstanding and committed but undrawn bank debt. You'll have some attestations to make, including that you will not pay down other debts except for mandatory principal payments until the loan is repaid. You will not seek to cancel or reduce lines of credit with any other lender. You'll have to make an attestation that you need the loan to deal with the crisis. It's unclear whether it will be a more significant representation than what you have to make for the PPL loans. It's interesting, they softened this requirement. We're going to go through requirements for the other loan programs in a minute, which generally require you to maintain 90% of your payroll. Here, it's that you have to make reasonable efforts to maintain your payroll during the loan term. There are going to be restrictions on executive compensation for 1 year beyond the loan term. These are exactly the same as the restrictions that apply to the other Treasury loan programs, which means that if you made more than $425,000 last year, you have to maintain or reduce that, but you cannot pay that individual more. If you made more than $3 million last year, the same rule applies, but the maximum amount is $3 million plus half the difference between $3 million and whatever that individual was paid last year. You'll not be permitted to make any stock buybacks or dividend payments for 1 year beyond the loan term. And I found this interesting. The entity cannot be held or controlled by the president, the vice president, a head of any agency, or any member of Congress. And we do have several agency heads who also own relatively robust businesses, so it's interesting that they put that in. So that's the scope of the program. There are unanswered questions. The way that you deal with your foreign affiliates is a very much an open question, and we're going to need to see guidance on that. You're going to have to put in your application what you intend to use the loan for. We believe that there will be restrictions on those uses similar to the Paycheck Protection Loan Program, but we're not sure because we haven't seen any of that. And they also likely will add other underwriting criteria since they expect the banks to process these loans and maintain them and not to approve them through the Fed. Why don't we do the last slide and then we can take questions. So there are other Treasury Department direct loan programs. These generally require you to apply directly to Treasury. They have similar restrictions to what we said before, except that they have a firmer requirement on 90% retention of benefits of workforce at full compensation of benefits until September 30th, 2020. The same exec comp restrictions. They also have an organized labor restriction that you're not permitted to participate. You're required to remain neutral for any organized labor election that relates to your company for 1 year after your repayment of the loan. And then there's also separate direct loan programs for larger businesses, air carriers, and businesses critical to national security. There's a separate Treasury Department mid-sized business facility that's allowed under the statute. I don't believe it's going to be set up at all. I think they're going to rely on this new Fed Main Street lending program that also is authorized under the statute. And with that, why don't we move to the last slide, and Chelsea and Blair, why don't you fire away with the questions that have come in.
Yeah, hi guys, it's Blair. I also just want to make clear that we will send an email to everyone who registered for today's webinar that will include the slides and a recording of the presentation. There have been a lot of questions about how you actually count the benefits. So I don't know if Kate or Scott, if you want to go over that again really quickly. You know, is it the employee share as well, or is it just the employer share? With retirement benefits, do you include the fees associated with it for managing that fund, and can you include the employer contribution?
So one way to think about this that I think clarifies it, at least for me, is you can't double count anything. So the employer gets to count everything they pay the employee, regardless of what the employee uses it for, right? So that covers the employee's component of the premium and any employee contributions to 401k plans and the like. In addition, the employer gets to count any of its obligations that it pays directly related to any group health benefits, so primarily medical, vision, dental, and the employer component of its contributions to retirement funds. Kate, I don't think we've gotten the question if the employer pays administrative fees separate and apart from that for retirement funds, whether they would be included in the payroll burden. Do you have a view on that?
Yeah, so my view is the way that it's drafted in the statute is kind of interesting, particularly on the group benefits side. It says something to the effect of all costs related to maintaining or providing group benefits. So if you think of it that way, then I think that, and you apply that also to the retirement benefit category, then I think that sort of reasonable standard fees that you pay as part of maintaining those benefits, I think you could, in good faith, include those. I don't see anything that explicitly excludes them.
Good.
Okay. How can you go over again how you would include part-time and seasonal workers, and how that may differentiate or not from counting full-time employees?
So I can do the seasonal and part-time. There are special rules for seasonal employers, so you get to use a special look-back period when you're calculating your average payroll costs. So this is for purposes of determining your loan amount. You have the option of looking back at just the period between February 15th and June 30th of 2019. Because I think they're thinking that that will be a more representative period of sort of full payroll costs for those seasonal employers. The full-time, part-time, and other basis employees, everybody counts as one for purposes of your employee count. So determining that size threshold, it's a belly button count. Anybody you employed for even 2 hours is going to count as one. And then and to be clear, other basis employees under normal SBA regulations would include folks like from a temp agency or from a professional employer organization. So that's an all-in number.
That's an all-in number for determining whether you're eligible for the program. And then you include really just your W-2 employees in your payroll expenses for calculating your loan eligibility and for satisfying the payroll payment obligations under the program.
Okay. And once a loan is approved, does the 8-week period start on the approval date? Does it start April 3rd?
We just got this information yesterday, actually. It starts when the money hits your account. When the bank makes the first disbursement of your loan dollars to you, your 8-week clock starts.
Great. And what about those sororities and fraternities that are 501c7s, but they have a foundation that's a 501c3? This is a question that keeps coming up.
From our brief life. So I think the foundation would qualify. They're a charitable organization, but the affiliated C7 would not.
And you have to remember those affiliation rules apply to nonprofits, veterans organizations, and tribal businesses, just like they do to for-profit businesses. So that foundation has to go through the same analysis as everyone else. So technically eligible as a 501c3, but to the extent you've got an affiliation with, you know, these different entities, you're going to have to aggregate that employee count, and that might put you out of eligibility. So there's no affiliation rule carve out for nonprofits. They have to follow the same rules.
Okay, here's one on if you are a non-U.S. citizen, but your business is incorporated in the U.S. and the business is located in the U.S., do you qualify?
So your business is going to qualify because it's located in the U.S. If the corporate structure is an LLC or an LLP, then the owner wouldn't be included in the payroll, and I think they're ineligible for direct payments under the program. But their business should still be eligible if it's a U.S. established company that's in business in the United States.
I think that's right. The one thing I will point out in terms of who you can compensate or count in your payroll cost calculation, the test there is your principal place of residence. So if you have foreign citizens who are living and working here in the US full-time, paying taxes here, then you can pay them and you can include them in your payroll costs, but you cannot include anybody whose principal place of residence is outside of the US.
And what about if you are a company, it's a C corporation, but it is owned by a foreign subsidiary, but it has a location. It has a location in the United States.
So companies that are based in the United States but have foreign parents, the US sub is eligible.
Okay.
Yep.
That was actually, I will tell you that on the original application from Treasury, they had something about whether any of the 20% or more owners were foreign, and that kicked you out of the program. That was one of the changes they made in the updated application, because I don't think that's the requirement under the statute.
Yeah.
If you're U.S. organized and domiciled here, you can have the foreign parent, and the U.S. business is still eligible. Now, what you do include the foreign parent and all the other affiliates' employees in determining whether you're size eligible, but they would count in the count, if you will, but that company is eligible based on the ownership.
Okay, here's a kind of a specific question for those that have fluctuating employee counts. So if you are a contractor who hires for a construction season and then drops down over the non-construction season months to a different employee count, how will the new ruling on average payroll costs affect that? So
they have a choice. They can use the 12-month numbers, their average monthly payroll numbers, and average counts, And I think you have to use the same, right? Whatever periods you use have to be the same for your payroll, for your loan calculation as they do for your eligibility. So you have three choices. You can use 2019, 12 months. You can use last 12 months, or you can use a seasonal period. What are the dates on that, Kate?
February 15th to June 30th of 2019.
So you would compare that to your, so that would be your numbers you could use. And so it'd be a 6-month number or approximately instead of the 12-month number. You can use any of them, but it would be the same for count as it would be for payroll calculation.
Okay. If you are a sole proprietor and you are the only employee, can you apply for the payroll protection program and also apply for unemployment insurance?
So I don't know. And this is one of those areas, sole proprietors are clearly eligible for the PPL. I think that something of the unemployment calculation is a state law issue, and whether or not they will include this within the calculation, I have no idea. But we don't even know exactly what the banks are going to look to determine what your loan amount is for sole proprietors. That's the guidance that I was expecting by today.
Okay. Going back to non-citizen employees, I know there's some camps that are listening to this call who use a lot of J1 students. So do you count those non-citizen employees in your head count? Like, do you use that amount to figure your loan request and then remove them and only count the US citizens?
So I think they count in the belly button count. So this is really that for determining your employee count size threshold. They really mean for that to be an all-in number, full-time, part-time, or other basis. So I would count them there. In terms of who you can count, though, under those payroll costs, if they get paid like normal employees, I'd include them. What do you think, Scott? I don't think there's anything special about them being non-citizens.
I think as long as they're legally entitled to the payments under U.S. law, which they should be by virtue of their visa status, they're legal residents for those purposes, I think it should be fine.
Yeah.
Okay, and this should be the last question. Currently, we count part-time employees as half an employee on our financial statement implied for the loan as such. Is it safe to assume that he should use the same approach for maintaining the employee count through June 30th?
So first of all, for the SBA rules, a part-time employee is a whole employee, not half. Second, they're going to use FTE rules for determining those calculations, whether you're kind of at the right levels if you had dropped down on your employment. And we don't really know what they're going to consider full-time and how you do that. I'm not sure it matters because I think if you think about it from an hours times people perspective, it's going to be a total number of hours worked for those part-time people, and regardless of whether they're 8 full-time equivalent, eight full FTEs or 15, either way, it's going to be the comparison between before and after, and so it should work out the same. I don't know if that answers the question or not, but Kate, do you have anything to add on that?
No, I think that's right. Folks need to keep in mind that there are two different employee counting things going on here. One is for this initial application, determining your eligibility based on your size. That's the all-in number. So it doesn't matter full-time equivalent, part-time, everybody counts as one. Where the full-time equivalent calculation is going to come in is not until you apply for your forgiveness amount. And then that's when they're comparing full-time equivalent employee averages to your 8-week forgiveness period versus pre-crisis levels. So nobody should be thinking about full-time equivalent employees right now. Doesn't matter right now. It doesn't matter until your forgiveness amount determination, at least 8 weeks from now.
Okay, we're gonna do one more question.
One more quick one.
And this is kind of similar lines about what we've been talking about for those businesses that really are only open for 6 months out of the year.
They would do the same seasonal payroll calculation.
And there is something kind of funny in the very most recent FAQs that Treasury put out that just says that your bank may consider whether your business was open during that seasonal employee period. I don't know what the heck they're supposed to do about that consideration, but there does appear they're trying to give the banks some leeway, I think, to maybe do a different, more appropriate seasonal employee look back period, but they really gave no detail on that. So it's something that your lender can take into account, but they didn't then give us any rules or alternatives to really go on there. So I would bring that guidance to your lender's attention and see if they'll work with you and just use, a look back period for when your business is operating during 2019.
Okay. This is Ken Carrar again, the CEO of the council, and I'd first like to thank Scott and Kate for a great presentation. It was very informative, and I hope all of you on the call got what you needed out of the call. There are a number of questions that are still left. I'm hoping that we grabbed the key questions, which probably cleared out a bunch of the questions in the list. For those of you who have asked, and again, we'll repeat, we are sending out this presentation along with the slides following this call. And we at the council are pleased that you've spent the time with us today. If you have further questions or concerns, I would talk to your broker. You're in great hands with good people. These are solid brokers. They're terrific to work with. And we're pleased to be representing them. So with that, we end the program today. I'd wish you the best, a great weekend. Stay healthy, stay safe, and I hope you and your families are doing well. Thank you. Have a good day.